Hello and welcome to the ASB Investment Podcast, the show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that will be happy to chat if you need. Well, hello and welcome to another episode of the ASB Investment Podcast, where we explore the people, ideas and stories shaping the world of finance and investing. I'm your host, Nigel Grant, and today's episode it's something really special. After a career spanning a certain number of years, I've just put certain in there just to make it, nice and soft. We're sitting down with a very familiar face and voice, none other than John Smith, our very own head of asset management. He's my friend and who's soon to retire from ASB. Over the past few decades, John has witnessed and been part of some of the most transformational shifts in finance and investing in New Zealand, from market booms to busts, the introduction of KiwiSaver, paper trading, moving to new technology platforms. He has seen it all. And today we're going to reflect on that journey, what's changed, what hasn't, the lessons John's taking into retirement and that you can think about and perhaps even use, and whether that's regardless of whether you're early in your savings journey or even if you're at a similar stage to John. So John, welcome back. It's great to have you with us, probably for the last time. I'm going to leave it hanging like that, but how are you?
I'm well, thank you.
Oh, Nigel. Look at the voice. It's back.
Great to be here.
I know how much you enjoy the hot seat. And
Absolutely.
So I know our listeners know about the farm. How is it out south? Is it cold, wet? What's been happening?
It's wet and it's muddy. It's getting colder. A typical winter, to be quite honest. There's lots and lots of leaves. We have lots of trees, and leaf blowing is an endless trial, because you go out there and it looks awesome, and then the next morning you wake up and they're all being blown back. And so, yeah.
Are there so many leaves that you don't bother picking them up?
Absolutely not.
Okay.
You sort of blow them into lines of leaves, and they become mulch for the trees. Yeah.
Oh, yeah. I try and pick them up, but I was just thinking your property's a little bit bigger than mine. Let's start at the beginning. You've spent years in the investment management business. What initially drew you to this field, and what's kept you motivated over the course of your career?
Well, the story about how I got into investment management is a bit of an interesting story in its own right? So in 1986, I joined the industry, and I was 1 year married.
Yep.
I was a budding entrepreneur running my own business, and I was laying slate, on my hands and knees, laying slate.
Yep.
And being one year into marriage, my wife, my background is maths and physics, particularly physics, actually. And so she said to me, get off your knees and use your brain.
Yep.
And so, of course, that was my wife. I did.
Yes.
So,
correct. Yes.
What do I do? So we knew through our horse connections of an actuary. And so I thought, actuarial, that sounds like the thing. Let's go for that. So I knocked on the doors of a number of insurance companies, and that's what you did back in the 80s. And I met this guy at a place called Aetna Life. He was the actuary, and he was also the investment manager. And he said, yeah, I'll take you on.
Just like that?
Yeah, he did. Well, back in the 80s, the markets were booming and they needed people, right? So he said, I'll take you on. I think you'll really like this investment management stuff. And he was right. I did. The actual studies just fell by the wayside.
Yeah, right.
And I just loved investment management. So investment management ever since. What's kept me motivated? Markets are endlessly fascinating. There's lots of human psychology on display. And I suppose it's also just having the opportunity to make a difference, right? So if you're managing people's money, then you'll make a difference to them if you do it well. So yeah, those are the things that motivated me.
And looking, I didn't realise, so you were involved, the horses side you were involved with before, that's been longer than the investment side?
Yeah, sort of came along with the old terminology as courting. So yes, part of the deal was my wife is really into horses, and it's a great thing. It's been a part of our life ever from the beginning.
Sure.
And
long may as well. Long may continue.
Yeah.
And so looking back over that period, I guess, less the slate laying side and more the investment management side, could you describe what have been the biggest shifts or turning points you've seen, I guess, across the investment landscape?
I suppose the rise of indexing has probably been a really big one for me. So back in the 80s and 90s, institutional investors it was mostly active management, and the big thing was multi-manager active. There was lots of styles of managers, so you'd pick managers with different styles, and the styles were relatively simple, like growth, value, growth at a reasonable price, momentum. And so the idea was, if you picked, say, let's say you pick a growth manager and a value manager, then they're both adding value. All management goes through cycles. If they go through different cycles, then you pick two with slightly different cycles, you get the same returns but a lower volatility. So that was the theory, and it was a good theory, except for one thing, and that is that not all active managers are actually that skillful.
Yes.
In actual fact, a lot of them aren't. And so what you ended up with a portfolio of lots of managers. You're paying high fees for active management, and you were getting the index because they were all sort of like not actually adding value at all because they didn't have skill through the long term. Indexing started to arise, and indexing started with a guy called John Bogle at Vanguard in the mid-70s. Sort of like indexing started coming into the institutional field. In my view, as you started to see this multi-manager thing play out. And so that was the rise of indexing. And then I suppose that was through the 90s, started growing and growing and growing, but then ETFs came along, and ETFs in the early 2000s came along and it really took off. So indexing and the rise of indexing, that shift in active management has been a really interesting dynamic to watch play out. The other thing that I suppose has really come through is the change in technology. So back in the day when I first started, if you wanted to trade a government bond, you used to have to walk down to the bottom of Queen Street from where we were up in Simon Street.
Oh, literally walk? Walk
down to the Reserve Bank, which is at the bottom of Queen Street, and actually like register your bond. A bearer bond was like a bearer bond is literally a bearer bond, and if you were the bearer, then you owned it, and if somebody took it off you, then they were the owner of it because it was a bearer bond.
Yeah.
Now everything's electronic. It's just everything. Yeah. So that's been like a huge change, and how fast things move now is phenomenal. Yeah. That's just really, really accelerated.
And what's been probably one of the most challenging periods of your career? Like, we've talked about GFCs and other major things, COVID, that's happened over the course of us doing these podcasts. But, is there any key moments or periods that have shaped your career?
Shaped my career? Certainly things that have stood out.
Yeah.
Like the very first thing, like I said, I got into investment management in 1986. So the very first event that really, really stood out was what's called the crash of 87. Mm-hmm. Now, not many people like of your age will even know what the crash of 87 was. You're only like 3 or 4. I
was still trading back then as well.
Yeah, exactly. But it's one of those things for me, being really early in my career that you remember where you were.
Right.
And in 1987, I was in the shower in the morning listening to a radio and heard that the markets crashed
overnight,
20% overnight.
Yeah.
And they were down 25% in that period of time. So that was really, really a seminal moment, and then the impact on customers and all the stuff and the noise that came around that was really important. And then of course there was the GFC. That's very, very memorable. And then of course COVID. Each of those things are memorable, but in many ways through the length of time, the thing that I've learned from that is, if you were to get a chart of the S&P 500 or the MSCI World and look back to 1987, you cannot see that was 20%, 25% in a very short period of time. You cannot see that. Back in the day of the 1987 crash, the S&P 500 index was 340. The index is 6,000 now.
340 points.
340 points. So the thing that I take from those events, which were really, really material, scary things at the time, was that one of the long-term tenets of investing is it's a long-term game. And so in time, it always fixes itself. The GFC, the market was, what was happening in GFC? The market was
down 50% over, a year and a half?
1,500.
Oh, the total index.
The index was 1,500, went down to 700. But it's 6,000 now.
Yeah, it's 4x from that high.
That's right.
Yeah.
And COVID, it was 3,300. Now it's 6,000. So I think that for all of the fact that those, to some extent, part of what my career is the OMG moment in 1987, who on earth thought this could ever happen, to the fact that those sorts of things have happened multiple times now. And the thing I often have heard is, well, it's different this time. And I've heard it's different this time, like 10 or 12 times in my career. It's just not different. The market will always recover, and equities always go up. They go up and down, but they will always go up through time. And so time frame is really important.
So technology, globalization, investor behavior, we've mentioned these things earlier, but also, numerous conversations we have had. What changes have had the most profound impact on how investments are managed, do you think, versus, I guess, today versus when you started, and potentially had the most impact on clients?
I've already mentioned indexing, right? So, and indexing, I think, is really profound, particularly ETFs, because it's democratized things. So, and it's changed things in the sense that it used to be that if you'd go to a fund manager, because the fund manager could buy more things and cheaper. I mean, you couldn't with $100,000 buy 1,500 shares, right? But you can by going into ETF, you can get exposure to 1,500 shares. So that thing has really, really changed. But more locally in New Zealand, I think something that is really underestimated in terms of impact is the PI tax regime. And that's, what on earth is the PI tax regime? But it allows people to invest and get their returns at their marginal tax rate. And most of the investment public these days will not remember it. But prior to KiwiSaver, and PI tax came in with KiwiSaver, if you invested in a managed fund, then that was taxed like at a company tax rate. And so if you were a lower income investor, you were getting taxed at a high rate on your investments. It was a real disincentive. And so the PI tax regime that came in the same time as KiwiSaver was like a major innovation, I think, in New Zealand in terms of encouraging investing. And then if KiwiSaver, of course, itself, probably won't spend any much time on that, but it's really taught people the value of just regularly putting money aside. I think that's really important.
Maybe we should celebrate the birthday of the PI tax regime more. We always do with KiwiSaver. What about a birthday cake for PI tax?
Yeah, well, I can still remember 2006 and 2007 when we were putting all that stuff together. It was. I was heavily involved in it at an industry level, and it was a major. But yeah, we probably should. But people don't really celebrate tax, do they?
And are there any, I guess, a decision or a key moment you're particularly proud of? I know you're one of the most understated people that I've ever met, but is there something that's left a lasting impact, you think, apart from PI tax?
Oh, things that I've been involved in, I think that I'd say I'm very proud of in terms of their impact. For ASB, it would be that I led us into KiwiSaver. So that was my thing. So it was an incredibly proud moment when we were selected as one of the few default providers for KiwiSaver. Not many of the banks were at the time. So we were the only named bank as a KiwiSaver provider. So that was a very proud moment for me. The other decision I think that I'm really, really pleased about and proud about was a decision that I made in early 2020 when we actually decided to extend our relationship with BlackRock to an outsourced chief investment officer. Now, that word outsourced is really interesting in that regard because I think we've said on these podcasts before, we really insource basically BlackRock's global capabilities, and we work very, very closely together with them. It expanded the capabilities that we can bring to bear for our customers and their benefit enormously. And that what's really, makes me proud is that 4.5 years in, the returns are showing up for our customers really, really well. So, that's something I'm very, very proud of. Yeah.
Yeah, and I think two things stand out for me in that last item. You did that all during all that. I guess what's it called? The negotiation and
implementation.
During COVID.
Yeah,
including some pretty, signing contracts, and there was some social distancing and stuff in that. We had to actually physically sign things. But also, what stands out to me is the people I think you've brought in from BlackRock, the people that listeners have got to know, and when they're in front of clients as well, it really shows. And they have got some world-leading capabilities.
Absolutely right.
That we benefit from. And looking back, I guess we're looking back at the whole podcast, but is there anything you'd wish you'd done differently or a hard lesson you think others could learn from?
No. I tend not to look backwards. I don't have any regrets. I don't do regrets. So, no, I can't think of it.
Okay, so my follow-up question was, is having no regrets the secret? Is that the lesson in of itself, just to always look forward?
I don't know. Maybe it is. I don't know. It's just it's just part of my psyche. I don't do regrets. Yeah, don't look backwards. Don't worry about what might have been.
There you go.
Look forwards.
Pause for dramatic effect on that point. There you go. So as you step away from the industry, what advice would you give to the next generation of investors or investing professionals?
I think it's really, really important to understand why you're investing. And I think that you often get caught up in just like maximizing returns. You want to pick the best stock and it's all about return. It's not all about return, it's all about risk and return. And so one of the earliest lessons I learned back in 86, actually it was, when I was investing, and there was a finance company that went broke. And I learned the lesson that the days then were when mortgage rates were like in their 20% level, and deposit rates were like in their high teens. And the banks were giving you like a 16% return, and yet people were still investing in a finance company at 18%. And it's like, is 16% not enough?
Yeah.
Why did you have to take on the extra risk? And do you not understand that extra return is extra risk? So
were there finance companies back then as well?
No, yeah, absolutely. That's another lesson that I would say through time, is that things repeat themselves. People's memories are short.
Yes.
And so either people's memories are short, or you get new generations who haven't had the experience of, say, the old codgers like me. And so the same mistakes keep getting made. And I think that, listen to people who've been through it before. It would be one thing I would suggest. But yeah, keep your eye on your goal. Understand what you're doing it for. As you get older, it becomes clearer that you need to put money aside for retirement. So you start becoming clear what the goal is, which is to have enough money to pay you a paycheck in retirement.
The paycheck, yeah.
And work out how much that is and all the rest of it. But get quite methodical about it, and then sort of like have a goal and understand what's the time period for that goal. If you have an understanding of the time period, then a lot of the short-termism goes away, because you're on a path. Everybody knows that if you're on a journey, maybe you're crossing the states and you're on the journey from one side to the other side, you break that journey down into chunks. You don't see the whole journey in one hit. You don't expect to get from San Francisco to New York in a day. It's going to take a period of time. And so if you plan out your journey, understand what your journey is, plan out your journey, and then a lot of the anxiety that comes along the way as you hit the bumps in the road sort of like goes away.
We've worked together for, my entire time at ASB, which is 8.5 years. And during that time, you have helped coach and mentor me the entire time. All throughout that period, though, there's always one thing that you've pressed on, and that's the importance of patience and having a long-term mindset. Nigel, have patience. Have patience, man. I just wanted to ask you, why do you think that value or approach has been so important to you? Or how does it come so naturally to you? Not everyone has that.
I honestly don't know. I think it's just experience, right? If you've been around for a few years, you've seen things happen, and you've seen things repeat themselves, and you see the value of patience, right? So, it's just as simple as that. It really is. You learn the lessons, and then those lessons become, lessons that you just take forward. So, as a young person, I was impatient.
I was going to ask.
In my mid-30s, I thought I knew everything, and it was like, why am I not the CEO already?
Yeah.
And then through the next few years, I started realizing that actually what I thought I knew, I didn't. Oh, I probably knew that. That was knowledge, but experience was something that takes a little longer, and what you learn from experience. And so, yeah, patience. And I actually can still remember one of my old bosses who was a very, very smart man, got very frustrated when he was working in an organisation and didn't understand why there was so much value put on soft skills. And actual knowledge is easy to come by. Those softer skills are much harder to come by, and actually much harder to explain to people what they're actually all about.
Yeah, and the importance of them.
And the importance of them.
And so you've seen so much change. What, in your opinion, has stayed the same?
Human behaviour.
Okay.
Despite all the techs and tools, then the thing that drives the markets is behaviour and psychology, right? So fear and greed still drive the market. Yeah.
And do you think that will ever change?
Will humans ever change?
Good point. Good point. I guess I'll take that as we'll still be having the same conversation in 20 years. Now, I want to ask you something a bit more personal, and I know you love personal questions, but it's still a safe area. So for our customers, and we've talked a little bit about this in the past, the paycheck, thinking about retirement, prepping for retirement, For any of our customers or listeners of the same age and stage of life as you, what's your current or your own approach to retirement looking like? And what are the key things you're taking into this next stage of your life?
Well, I mean, from a personal level, I'm just looking forward to sort of like spending time on things which are less about waking up early in the morning and driving to work and all the rest of it. Spending time on the farm, just doing what I want to do when I want to do it. Time with my wife.
Are you still going to have an alarm?
I'm not going to set the alarm. I'm going to try and turn the alarm off.
Good on you.
Ditch that. I'll keep myself busy, but we still have a small business we'll operate. I'll still be linked to ASB through the ASB Investment Committee, spend more time with the family, spend more time with the grandchildren. I think the kids are looking forward to that. We'll travel a bit probably. But in terms of just the financial side of retirement, again, it's about budgeting, right? I mean, at the end of the day, you need to figure out what it is, how much money you need to live your lifestyle, what sort of lifestyle you want to live. And you need to work out what the resources you've got at hand are, and like the assets you've got, and how much you can generate from those assets, and how much you're going to get from the pension, and put all those things together. And like, just retirement's a long thing. I've been planning for retirement for 20 years, but retirement is like longer than that. It could be 30 years. So you've actually got to think about it and be deliberate about it again. So not much different from the way I've managed things coming into retirement.
Just a bit more time around all those DIY jobs.
Oh yeah,
that are mounting up.
Yeah. Actually, yeah. My wife says she's got a list, so it's going to be interesting.
You've said to me,
I'm not show me the list yet.
You've said to me, I'm not retiring, Nigel. I'm just doing other work.
Yeah, that's right. Different type of work.
So, final question before we get into the finale. As we wrap up, rather than a book or a podcast or a TV show, you can always mention it if you want. Like those recommendations we normally talk through. Is there anything you'd like to leave listeners with? Any sage wisdom?
Not really.
Great.
What I found remarkable is you just keep on learning. It's not an end point. It's just a point on the journey through your life, right? And I've learned new things in the last 5 years as I've learned prior years. So it's like you don't know everything. You never know everything, and there's always new things to learn. And so stay curious. Stay curious. And like one of the wonderful advents over the last few years is podcasts, right? And your ability to listen to stuff. So in my journeys to work and to and from work, those long drives that I do, I used to listen to the radio. Now I listen to podcasts, and the range of stuff you can listen to, and the research you can listen to, and the various things that you can create an interest into and dive into through podcasts, through YouTube is phenomenal. So just keep on learning.
And can you hear a podcast while the leaf blower's going?
Yeah, sometimes actually.
Okay.
Yeah,
okay.
Yeah, that's right. Well, on the lawnmower. Yeah.
Have you got a ride on?
Yes.
Oh, of course. Yeah, I like that. I like that image. John, thank you for sharing your story with us today, and congratulations on a truly. You told me not to use superlatives.
No, please.
I'll say. On a truly good career. I'll leave it at that. We've got a number of farewell events and moments coming up where words will be shared, so I can save some of mine until then. But on a personal note, related to the show in particular, you've always been a big backer of the podcast and our efforts, I guess more importantly, our efforts to help investors and customers know what's going on. Not just like what is going on, but also what our thoughts are on it and why it's happening, but also what we're doing about it. But also, as you've coached over the years, we might not be doing anything about it because we're set up for this. So you don't feel like you have to do something every time something happens. And this show,
doing nothing is still a decision.
There you go. Mm-hmm. See, that's what we sort of said before. That's the soundbite. And this show is better for having you involved in it. So thank you for pushing to do it. Even if listeners might not know something, that despite his made for podcast voice, John actually gets a bit, and I can say this because this is the last one, gets a bit nervous before each show. We go through a process each time, and I just sit here and harper on about things, and he gets ready and sort of looks through his notes. So because of that and how much you love being in the hot seat, I got you something to recognise that. So I need to step away from the mic and get it and pass it to you, and then I'll come back on. So hold on 1 second. Okay, I'm back. So you can open it now and I can narrate it, and then you can tell the listeners what it is. It won't embarrass you, okay?
Good.
Okay.
I'm easily embarrassed.
My God. What is it? What is it for the listeners?
It's a photograph, a framed photograph of me smiling and sitting in this seat.
It's a photo of you doing the podcast, because I know you can now experience this wonderful memory every day at home on your mantelpiece.
Yeah, indeed. Thank you very much for that.
So
That's very nice.
I have not signed it, but I can do if you want.
Yes, you can sign it. I'd love to. I'd love you to sign it.
So I look forward to seeing that one day. Yeah, pride of place.
All right. Thank you, Nigel.
Thanks again, John. I hope you enjoy the next 2 weeks and all the thanks that come your way, because you thoroughly deserve it. And until next time, happy investing, and in true John Smith style, stay patient. And it's bye for now. Thanks for listening to the ASB Investment Podcast. If you have any thoughts on this episode, or if there's anything you'd like us to discuss on a future show, get in touch with us at podcasts@asb.co.nz.